Hi, I'm Joel Gilgard with Gilgard Analytics. Thank you for tuning in to this YouTube video clip. This tutorial will be covering the 2022 summary of emerging stock markets. And this covers a period of 21 years. And the reason why it's not 34 years is that I do not have a full set of 34 years for any of these countries. This covers, and so Gilgard Analytics has created an equity index. It's a GEI, Gilgard Emerging Equity Index, and it's an average of 19 equally weighted, 19 emerging equity markets. Now, these don't necessarily have to be, new companies. It's just I define them as emerging because I do not have sufficient data to cover the 34-year period. And these are, inflated, or they're adjusted to the Gilgard inflation adjusted dollar. In the first graph you see in the background, and I'll make it larger, it's tough to see here, is the cycle value, and this is where it's a rating that each country gets, where it's at in the corresponding business cycle for each country. When the number is negative, that means that it's more valued than the average. The further down you get to 8 or 10, that means that it's very overvalued vis-a-vis its historical averages. And likewise, if it's in the positive, that means that the stock market is priced below its historical averages. And so in 2022, you have Israel, Denmark, and Norway. They're displaying some frothiness in the market. And you have Greece, although Greece has done pretty well, they are still considered a bargain, as is Chile. You also have other countries like Brazil, China, Mexico, Finland, Poland, Pakistan, Czech Republic, Hungary, Colombia, and Russia as being below average as well. And I have a feeling Russia is going to crash, become much more valuable in the future, or at least less expensive. And then you have a country like Poland. When you see a 0 here, you don't see anything. That means that they're fairly valued in Gilgard Analytics methodology. And so, taking all of these 19 countries and averaging them out against their own 21-year history, they're equally weighted. This is what the Gilgard emerging market looks like, inflation adjusted. And one thing that is fairly interesting with this index is that when it falls very sharply from one year to the next, becomes a very lucrative trade to buy it. And in 2007 and 2008 would have been time to buy it. So currently, it is pretty average valued. So neither overvalued nor undervalued. So very, very neutral. This chart displays and this is Gilgard dollar inflation adjusted returns. Which country out of the emerging markets which has done the best? Have Peru, Denmark, Argentina, Israel. So Peru is basically giving you a 7-fold return. Greece has done the absolute worst. Definitely has been a wealth destroyer over the past 21 years. Finland has broken even. So after the 2001 crash, when communication stocks were highly valued, Nokia has really taken a beating. And so here are the returns for last year. And here you have Argentina and Chile, Peru at the top. Peru done didn't really do that much, but Argentina and Chile. And then at the bottom, not surprisingly, you have Russia. Pakistan is pretty much a wild card. They're the smallest valued company, stock exchange in the world. And there are three different types of data here. You have unadjusted data, and so this is basically data in the individual currencies, country currencies, stock markets for that particular year. And you can see here, Brazil, they have a very high rate of inflation, goes from 11,000 to 104,000. But when you adjust this for inflation in dollars, still did pretty well, right? It went from 1905 to 8,100. This data then, as I mentioned earlier, it is basically, in order to put together the Gilgard Emerging Stock Market Index, each country, each data point is compared to the historical average, and these are then added up. These over here. So here we have all the averages, and this is what comprises the Gilgard equity index for the emerging markets. I hope you found this tutorial helpful. If you have any questions or any comments, please let us know. Thank you.